On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Torres Report. I am your host, Todd Schoenberger, and joining me, as he always does every week, is José Torres, the senior economist at Interactive Brokers. Jose, we have a market sell-off right now. It has nothing to do with the CPI number that came out. It has all to do with oil. We had the EIA that said that we will be releasing 400 million barrels of oil, yet oil prices are still moving higher. What does this say about future inflation rates? And do you think this is going to change the way the Fed is going to think?
Well, Todd, great to be here as always. Absolutely. Here at Interactive Brokers, we track real time what inflation is going to be for the month of March. So far, we have 11 days of data, 10 and a half, because today's not over yet. And the CPI is poised to jump up to 2.9% in March, a report that we get next month. I'm going to copy and paste the chart here while we talk here, Todd, just in case you want to show it to the folks.
Yeah, go for it. So hold it. Let me get this right. You're suggesting that the March CPI, we will be popping up to 2.9% on an annual rate, correct?
Yes, that is correct.
Wow.
And really, Todd, what's happening is we're up a ton on crude oil year over year. We're up north of 30%. So how could you, I just emailed you that chart. I think it'll be useful. Ladies and gentlemen, if you have a year over year jump in crude oil of 34%, and we know crude oil is pivotal, and even though the Fed only looks mostly at the core aspects of inflation, look at airfares. That's a service. That's directly linked to jet fuel costs. When you look at food away from home, when you look at products that are being moved around, fuel is a huge input. So when you have these numbers here, 34% year over year, last I checked, probably 35 or 36% now, you have these annualized figures that are materially going to bump up the CPI, similar to what Russia's invasion of Ukraine did back in 2022. Now, of course, we're down a lot from the 119.48, I want to say, was the high from Monday. We're down a ton from that. But we're still north of $87, Todd, which is significant and signals that market participants are pricing in a more extended conflict. President Trump quelled those concerns by saying that he thought that the war was almost complete, almost over. However, the Iranians have shown a lot of might and endurance in their ability to keep up with the American forces as well as the Israeli forces. And they do have a deep arsenal of weaponry that they can continue to use. That's even, some reports, I'm by no means a military expert, but some reports, gauge that the U.S. is going to spend a lot more than it anticipated in its war in Iran.
Yeah, I would think so. And looking at your chart right now, and we will provide this on the show when it goes through the editing process. But I will say it's a rocket shot. When I look at this and I see a 9% print for the month of March, when that CPI number comes out in early April, that's going to scare the hell out of everyone. And I know we have a Fed meeting coming up next week, but we have to, next week, but I believe, or 2 weeks from now, but I believe that we will see, this is going to really move the needle in the way the Fed is going to be thinking, especially now that Powell is coming up on his final 2 months here. With that, Jose, though, what really concerns me a lot is that 400 million barrels did nothing. If anything, it absolutely is inconsequential to traders right now. What do you think, though, if the war continues into April? What kind of a pop will we see in inflation at that time?
Oh, God. I haven't looked into that, unfortunately, yet, Todd, but we're going to be north of 3% if we keep going, just because we had such a long period of low oil prices. Remember, it was a huge feature of the Trump administration. We're going to have record oil production. We're going to have milder regulations that's going to subdue energy costs. And it did. And it also served as an offset, a countering effect for any potential inflation that you could get from tariffs. Now, we didn't get much from tariffs. That's great. But prior to the tariffs being implemented, the Trump administration didn't know if tariffs might cause some kind of uptick in costs. So to hedge that, they really wanted low energy costs. We enjoyed low energy costs all of last year and coming into this year, really up until the Iran war. But we should mention also that crude oil has been trending up since the beginning of the year. It started the year at $55 roughly, and now we're at 87. So, we're really, really high. We're almost a double here.
In your opinion, do you think that the EIA saying we're going to release 400 million barrels from the Strategic Petroleum Reserve in Cushing, Oklahoma, by releasing that, though, we pump our own oil domestically. We don't have an oil shortage here in the U.S. So gas prices are moving higher because oil is a dollar-denominated commodity, and therefore we are seeing the remnants of that from the Iranian war. Plus, the losing 20% of supply is for the rest of the world, not for the U.S. The question I have for you, though, is why do we release anything from the SPR? It doesn't seem to make a hill of beans difference for the United States, but am I missing something?
Well, I think that President Trump here is turning, he's wearing now his more traditional GOP war kind of hat. He's looking to police the world and be more of a globalist at this juncture, even though, traditionally that's not his brand. And I think that he does care what happens with global energy costs. And just because we have a lot of oil here, it doesn't mean that producers won't take advantage, suppliers won't take advantage of higher spot prices globally and then raise prices on U.S. consumers. It is moved by global markets, even though, of course, we have a lot of supplies here. As far as 400 million, there's demand is 100 million barrels a day, roughly. I haven't checked recently exactly. It's probably 102, 103, but it's right around 100. So 400 million barrels essentially is 4 days of global supply. So that also it points to why we're not having such a significant reduction in oil prices. In fact, we're getting a slight increase. And I think it's part of President Trump's, he's trying to boost his approval ratings prior to the midterms. We know the Republicans, usually the party in power, takes losses in the midterm elections. Our prediction markets here at Interactive Brokers show that the Republican advantage in the Senate is close to gone, down to 58, 57%. Democrats are handily going to win the House. And then governorship races are kind of split right now. So, oil prices, Todd, are huge for middle class America, lower class America, folks that are out there working check to check, folks that are out there struggling. So you're going to struggle to get that vote if you can't either lower oil prices or show the world that you're trying to. And that's what I think President Trump is out here doing, showing everyone that he's trying. $100 oil was that key psychological level where essentially President Trump said, okay, we need to come out and do something ASAP. And I think that's exactly what happened.
Yeah, I mean, I'm even hearing whispers of $200 barrel of oil.
Oh, God.
So, exactly. So you had once told me, though, Jose, that because of the Ukrainian war with Russia and Ukraine, because of that war and what had happened and what was going on with that war, our Fed had to hike rates. You were saying by 150 basis points. Did I get that right, or did I get it all mixed up? Because I'm sure the audience is just as confused as I am.
Right. Absolutely right. The Fed, these are nerdy topics, Todd. That's why you bring me on the show, folks. 525 basis points of hikes. So my point to you, so we got up to 550 on the up range, right? 525 to 550. That would have been 125 or 150 less. So the Fed would have still hiked, but not to that degree, 150 basis points less. We would have had a Fed funds rate in the high threes rather than the mid fives, because that crisis drove oil up to 120 and it stayed there for a long time. And that's the risk. You can have a spike up and down not a big deal. But when you get up to 85 and now you're staying there, now, now your annualized figures are starting to, every day that you're up there, it's really working against you on the inflation battle. 35% year over year now crude oil is. Let me give you the exact numbers, folks. Right now, crude oil is $88, and a year ago, it was $65. So that's roughly 35% growth. How can you have inflation at 2%, ladies and gentlemen, with 35% growth in energy? Unless everything else is going to hell, absolute declines, you can't have it. So we're looking at 3% inflation. Fed cuts are being worked away. Right now, the Fed midpoint is at 363, between 350 and 375. So the midpoint is just 363. The 2-year Treasury yield is a good gauge on what's going to happen with Fed cuts going forward. Where is that at? 363. Essentially, the Treasury market is telling you that the Fed is at neutral. So any rate cut it does will probably be undone soon. So we are either in steady mode, light cut, or reversing into hikes. But that is such an issue. And we're going to be talking about that on the show, against the backdrop of a president that specifically elected a Fed chair that he thought, in my opinion, would do his bidding, would go in there, lower interest rates, make it better for American families to own homes, make it better for them to afford their debt payments, right? So against that backdrop, that is going to be extremely interesting to see how Chair Warsh manages the expectations of the president while also prioritizing, or to a lesser extent, the Fed's dual mandate of inflation and stable labor markets.
Yeah, I would imagine Kevin Warsh is hiding in his basement right now, seeing what's going to happen here. But here's the question, though, of the day. So if you have a prolonged war, right now we have over a dozen countries involved one way or the other, whether it's direct action or providing the land for us to actually transport troops into this war. When you have that in that type of involvement, and we could possibly have a prolonged period where we are fighting and I guess having the regime change and doing everything we need to do in that area, are we at risk? You just said we might be walking into a situation where we have to hike rates. If that happens, Jose, how catastrophic would that be, not just for the economy, but really for the stock market that's been expecting rate cuts all along?
Yeah, it would be catastrophic. You're already seeing it. All the benchmarks are down on the year. The Russell is holding on to a slight gain. It was up 8% year to date just a few weeks ago. You'll see similar to a 2022 year, a 20% decline. But you mentioned something critical, Todd. Now we can be talking about patriotic rate cuts. The nation is at war. During this period, forget about inflation. We need to make sure that we have lower borrowing costs in the short run because the nation is at war. So, that's also, I don't expect that to be the case. I think that President Trump is going to somehow end this pretty soon. That's my general sense of things. But if you think that we're going to have a longer conflict, then, will the Fed and the Treasury start to essentially do whatever it takes to essentially boost the American economy and make sure that we don't run into recession? You don't want to be in a war and in recession at the same time when your own institutions aren't really supporting that growth. So that would be an extreme scenario. The same way COVID was. COVID rates went down to zero. The Treasury started spending like there was no tomorrow. Paychecks straight to the mailbox. Those are emergency measures. So if that's the case here, then I'd expect a similar kind of response. All bets are off. We're going down to zero on Fed rate cuts, and we're going to start spending more out of the Treasury.
Good God, if that happens, that would be a complete reversal.
And
I don't think Americans voted for any of this.
Todd, if that happens, we need to refinance our debt because in COVID, the 10-year was at 1.5. Okay, we should have been and the 30 was maybe at 2% or 2.5. We should have just rolled all of it into 30-year debt. Our interest payments would be a lot lower. So maybe next time, if there is a next time, if we ever are able to have rates that low, then maybe we're wise enough to refinance that debt.
And in the grand plan of things, it does seem that that could be where we're going with this. But you really have to get everybody to rally behind the president's and the country's mission for this takeover of Iran. We've been very spoiled lately. Our military is so precise and elite that we have the ability to just go in, do the action, and get out. Now, it seems like not a lot of thought was put into the planning, or at least the post fighting planning. And I think that's where everybody is uneasy right now. And we could see some issues down the line. It's going to be very interesting during this election year. I do have a question though. Interactive Brokers has a prediction market, a prediction exchange. Do you have anything out there right now that's currently predicting whether we will have rate advances, rate hikes later this year?
Yes, absolutely. Yeah, we have the Fed funds contract, and really, it's been really telling the same story as the Fed funds futures curve, as well as the Treasury complex, of expecting less rate cuts this year. I'm just looking through exactly where we are.
Well, I know you were you were at the beginning of the year looking at 3 rate cuts. Now you're looking for 2 rate cuts. It would be interesting to see if people at Interactive Brokers are now thinking we might have rate hikes.
No, right now, nothing. No one's pricing in rate hikes.
Okay.
I think the
I'll be the first one.
The the force of the president, would just is not really opening up that trade. Not even the Fed funds curve. There's no probability of a hike this year, at least. So let me look into next year, actually, Todd, real quick before we go.
So while you're talking, I'll editorialize here. So I mean, if you have rate hikes here, this is really a rhetorical question for you because everybody knows rate hikes going into a midterm election year. There's no doubt about it. The GOP will lose power in, obviously, you mentioned the House, but clearly in the Senate. And that could just really take the president's policies, they'll be off the rails going into his final 2 years, and he would be considered a lame duck president then. And it could really shift the balance of power in 28 when we have another presidential election. So it would be interesting to know what Interactive Broker clients are thinking, because if they're thinking hikes, even if it's in 2027, that doesn't bode well at all for the overall U.S. economy, and therefore it translates into a change in power. But what do you have?
Generally speaking, we don't have any hikes in 2027. The Fed funds futures curve doesn't have any hikes in 2027. But the 10-year is at 4.21. So over 10 years. No. The 10-year yield is at 4.21. So that would imply that over the next 10 years, the Fed funds rate should average around 4.21. So over the next 10 years, we'd expect 2 rate hikes or so. But that, of course, is an imperfect measure because it's so long term. We look at some additional things real quick before we go, Todd.
Yeah, it is. You're right. It is imperfect. But that, economists, you can only predict the future by looking at historical results. So it's important that the data that you are providing, it does help to provide and at least form a forecast for what could be coming down the pike. And very rarely are Wall Street economists incorrect with their forecasts. I mean, the present company included in that one, Jose.
Yeah, so here the 5-year yield goes up to 3.78. So essentially one rate cut along that time period, rough average rate hike rather. Folks are essentially saying that, thinking that the president, while he's in office, isn't going to have a rate hike, albeit he doesn't control the Fed. And then there might be hikes after the Trump administration. I think that's, generally speaking, what these curves are telling us at this juncture.
I would imagine that there will be, and that's going to really change fiscal policy. There's no question about it. I mean, monetary policy, obviously, but on the fiscal side, it should, because what comes out of Congress at that point is really, especially, I mean, they may not pass anything that the president wants. You talk about tax cuts, you talk about all kinds of things. Everything in the Big Beautiful Bill Act will remain in place. But it'd be interesting to see what happens going into the 28 election at that point. Jose, we're going to leave it there because there's so much more. We got the PCE number coming out on Friday. Any quick forecast for the audience before we go for the day?
Yeah, I think it's a good time to, I think we're a headline away from a big recovery here in the market. It seems like there's been the Iran fear is peaked when you had those oil price spike. And we've had really stocks, Todd, have been sideways for 6 months at this point. So the economy has grown during that time. Earnings have expanded. So whoever was scared about valuation 6 months ago, should feel a little better about cheaper stocks today. And, I think that's part of the deal. I think duration here is time. It's time to get it on the 10-year at 421. Even if it goes higher, I think eventually it goes lower soon in the next 12 months or so. I don't think $87, $88 oil is here to stay, folks. I think we're going a lot lower soon.
Well, I have to agree with you on that statement. I mean, once we get the Strait of Hormuz reopen, where it's just clear passage for all the tankers with the carrying of the oil. I mean, each tanker, for the audience, is carrying approximately $150 million worth of oil, every one of them. So that's why they're so expensive to insure, and that's why they're not going into the strait. And more importantly, nobody wants obviously to take the safety risk either. So there's a lot to that. But we will see. But I do agree with you on the price of oil. It will eventually drop only because we have so much supply, and really demand has actually been low from a global point. But that will remain to be seen. But Jose, we meet every week. Next Wednesday, we will be meeting again live at 2:00 Eastern time. You will want to be here to watch and listen to Jose and what he has to say, because we have a lot going on, especially that critical March Fed meeting. And we'll get into that, and we'll give you a preview at next week's show. So, Jose, thanks for joining me today. I can't wait to see you next week.
Likewise, Todd. Looking forward to next week, and thanks for having me today. Bye, folks.
Absolutely. So on behalf of Jose Torres, I am Todd Schoenberger. Thank you once again for joining us on the Torres Report. Coming up tomorrow at 12:00 Eastern live, Financial Compass with Ms. Schneider. She's going to tell you all about the oil trade. Boy, does she have some surprises. You will not want to miss that episode. 12:00 tomorrow live. Until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.